Wednesday morning, Fed Day. So here we are, peoples. I had shown you some charts from North Star, Kevin, and I wanted to follow up with a lot more detail of my own. I use a couple of his charts, and so this is. It's not just because of the FOMC. It's kind of this is where we're going, short term, near term, and maybe over the next year or two. So let's start with a few things um, that I organize this pretty well, and so I don't get off track too much. So I call it the current state of the markets and the economy. Again, sort of a forecast, a probability as opposed to an absolute. So one of the things that happened last week that sort of cemented the case for a rate cut, and very likely three 25 basis point rate cuts in the next three Fed meetings, and more on that. So, what happened? Well, we're losing jobs and inflation is persistent. Last month's CPI projected out to over 4% annualized inflation. So on one hand, we're starting to have inflation. On the other, the job market is really slowing down. So you would refer to that term, and this was persistent in the 1970s and was referred to as stagflation. You won't hear the news telling you this. They really don't want to bring that up. You might hear an individual analyst say it, but you won't hear news people really saying it. So why do we get these constant revisions? So let me show you the chart of the S&P 500, tell you why I think it's toppy, and then go into why these job revisions are happening in the first place. So when we look at an S&P 500 chart over this time frame, which is a daily, so it's going back several months, right? Maybe 6 months. So what do we keep doing? We're forming a wedge. This is known as a rising wedge. So you hit the top three times. We've hit the bottom one, two, three, four, five, six. So the probabilities now have us at 70% that we break down. Rising wedges in general are bearish patterns. Doesn't always mean it has to be. Again, could we go on up for a couple of more months? Yeah. But when we have a 70% probability, then by the time I show you a lot of other data, I think you'll come to the same conclusion that I have. Right. So a rising wedge probably around seven. This is just a random. What is it? Um, the U.S. dollar and the Japanese yen, right? But you see the same pattern. You see a rising wedge where you have higher highs and higher lows, and you have support and resistance, which is exactly what we have, right? And so you could pull back here and then go up even higher without really breaking through. Now, do I think this is an imminent crash as opposed to a breakdown? I see it as a breakdown. And I think that it could lead to a 20 to 30% pullback over many months. Probably would take us into 2026, into the first quarter. And I'll tell you why I say that, because I don't think it's just a deep, 3 day 30% pullback or 5 day 30. I don't think it's that type of thing. So let's look at another problem that's going on in the marketplace. It's been going on about 6 months, but over the last 60 days, it's really gotten out of hand. So billions and billions of dollars are insider selling. Now, if I showed you a chart like this over 10 days and there were some insider selling, you know, at $1 billion, I can say, well, this executive, Mark Zuckerberg, needed to avoid taxes because he had performance incentive options that he elected to take, and therefore he had to sell, $50 billion worth of stock in order to pay the taxes on the 500 million that he's elected to take in the option gain. So there's all kinds of things that can cause some selling. But in a typical market, if you go back over time, you should just about see red and green equal. Not what we're seeing here. We see 4 days where green is really showing up, and over 60, 56 days where it's red. And in this particular day, it's more than 3 billion. I'm not talking about small chump change. This is major selling. And it often happens. Remember who's doing this. What's the definition of an insider? It's a CEO, it's a CFO, a COO, sometimes a board member. So these are very knowledgeable people with insight deeply into the company's economics. Now, they're forbidden to buy or sell the stock within 30 days of reporting earnings. I mean, the SEC and everybody else has figured out that wouldn't be fair. If you knew you were going to report poor earnings and within a week of them being announced or 10 days, some of these companies can process them very quickly. So they know, and that's why that 30-day window is there to really cover even the smaller companies that truly take a long time to have their accounting company run the numbers. So, you know, all this stuff that I just said is here in writing. So this is a very lopsided situation. And it's not earnings specifically related, right? Because again, they can't do it by law. And the same thing goes if they invest in a company, and I think it's a 10%, it might be 8%. If they buy shares and they end up owning more than a certain percentage of a company, they also have to report that. And you're not seeing that. So they're not selling this to then go invest in something else. So let's touch on these revisions and why. Ignore this for the moment. I'll get into this. So, when I'm talking about revisions, I'm talking about the Bureau of Labor Statistics revising the data. So, we'll come out 3 months after the fact and say, oh, you know what? Like we did on September 9th, 911,000 jobs is the new revision that were further lost. And you shake your head. Trump got really mad and fired Erica McIntar- McIntarfer, who is the commissioner of BLS, the Bureau of Labor Services, the statistics. So, not all her fault, but clearly there's fault to be had. But let me tell you what, as I understand it, a solution would be simple, but government never does anything logical or simple, in my opinion. So, and that's on both sides of the house. I'm not getting into the political game here. Whether the firing was justified, not justified, you make up your own mind. Okay. So the issue here is the voluntary nature of the reporting. If the IRS sends you a notice and said, hey, it happened to me, I think back in 91, I remember I got the mail um, and it had been forwarded. I had moved and then I got it and I literally had 4 days to respond and it was beginning of the Thanksgiving break in I think 1991. And basically what had happened is I had done a bunch of trades and a bunch of options and I had missed some of those. I had missed about 100 trades and I had like 600 trades and I was doing my own taxes. I was using TurboTax, and because I was figuring, but I had them in a spreadsheet, and I forgot 100 of them. So literally, what happens? I'll give you an example, and this shows you almost what's going on there. So when I did the taxes, I said, okay, well, I bought this stock for $80, and I sold it 3 days later, a swing trade for $86. So I made $6. Well, if you leave that off the IRS looks, they get a report and it says you traded $4,800,000 in buys and you only had this many in sells. They look at it like I missed reporting that whole $80 buy. All they know is they got data on, 500 shares at $80, and they didn't get the $86 sell. They only got, and so they assume that all of it is profit. So they sent me a notice and said, if you don't get back to us in 30 days, we're going to see these are all accurate. Well, with me moving and the forwarding of the mail, I have 4 days left to respond to them, and I believe email was okay. So I had to sit down and do the data, right? So I worked like 36 hours without sleeping. I ate a little. I literally got all the data into that spreadsheet, sent them an email, and said, no, it's not a $2 million gain. It's like 20,000 gain, because here's all the cells that went with the buys, right? And so they wrote me back, okay, we understand. But, they were asking for like $464,000 tax owed. And it was going to be a final decision if I didn't reply in 30 days. And like I said, I had 4 days to go. So just one of those circumstances. But why doesn't now? The reason I'm telling you that story, so the Bureau of Labor Statistics sends out surveys to companies, and they say, hey, can you update us and let us know, do you plan on hiring over the next quarter? Did you fire? What's your net employee gain versus loss over the last 90 days? And what do you see over the next 2 quarters? Well, if the CEO or CFO, whoever gets that on their desk, is busy, they just go put it in another stack and say, yeah, I'll get around to it. Maybe they don't get around to it for 4 or 5 months. But if they said, hey, here's data from Bureau of Labor Statistics, we need this survey data, and we need it in 21 calendar days, or your company will be fined $15 million. I guarantee you that data would get done, just like when the IRS hit me up, right? I didn't have 464,000 at all to pay that, right? So it scares the bejesus out of you. So now they're not going to be scared to the same degree, but when you got no penalty, so that's what's happening. Think about it otherwise psychologically. So when they have good news to report, they might likely say, hey, very proudly, we hired 20,000 net new employees over the last 90 days, and we're very likely going to hire 5 to 10,000 per quarter over the next 2 quarters. Boom, sent off. But when it's negative and you plan layoffs and everything, do you really want that news to get out so quickly and have your company associated with the government that way? You're not in a rush to do that. So it's not like somebody's falsifying the records. It's just, I think there's a drag factor going on. So anyway, I thought I'd give you my 2 cents on that. So what can we expect and rate cuts, right? So we've got this job slowdown. We got the government wanting cheaper money. Cheaper money is perceived to rally the stock market, right? Why does the stock market go up with the perception of rate cuts? Because they see it as lending at cheap money. You can borrow on margin. You can, everywhere in your life that it affects interest rates, you want cheaper money. Okay, so the Fed Watch tool now, if you pull that up, it's a great tool. Um, they're projecting a 25 cent, sorry, a 0.25 or 25% of, a rate cut. And then we have 3 rate cuts remaining this year. We have one on 9/17. We have one on 10/29. Roughly, they're about every 6 weeks. And then we have one on the 10th of December. So all 3 of those have a greater than 50%. We have a 96%, 75%, and 67%. Now, we have them into next year, but they start lowering in the percentage. And I think with the stubborn inflation, that you're not going to continue getting rate cuts. We may even get to rate cuts going higher. I think by the end of the decade of the 2020 into 2030, we probably have double digits, similar to 1970s, 12, 14%. And that's going to be ugly, guys. But that's usually associated with a commodity super cycle, and that's how things end. Okay. So, having said all that, so markets in this stagflation environment, I think we're unlikely to get 50 basis points cut today. I think they'll be very conservative. They'll do very likely 25 basis points three more times this year. Okay. Well, in my opinion, the market already is baked in a 25 basis point cut. It's already has it. So what happens? The Fed historically cut before each market bottom, right? So the way you can look at this chart is the blue line tells you when the market bottoms, and the black line is telling you on the rate cuts. You see it go down. So it starts cutting, and what is that happens? The market bottoms and stays flat, and then finally turns up. What happens here? Right? The market bottoms, they've been cutting, cutting. It's because you're typically already in a recession by the time the Fed cuts. They're late. They're almost always late. It's the nature of the beast. So markets typically rally on, I'm telling you what I just said. So I type it in here so in case somebody wants to read it, but I kind of know the data. So markets typically rally on the idea of cheap money, rate cuts. But then the rate cuts start, typically the markets begin to sell off. Fed's usually behind the curve. So how do I see a slowdown in sell off? I don't see a big drop. I don't see a 5 to 10 day 30% drop like taking the elevator down. We took the stairs up and the elevator down. We get those sometimes. But my sense is we've already been in this topping, and now we may just not see any new highs, but we continue topping. It may take us to the first quarter before we reach a 20%, or 30% net down from where we are. So, but after weeks and months, we're very likely to get this downdraft. So, most only know there's a lot of young people in the market, right? More and more every day, young people come into the market. You had COVID, you had that big fear. So, the mentality of the psyche is, oh, yeah, you get a 20 or 30% drop down, you just keep buying the dip, and it's all coming back. And 3 months would be right back up and going on to new highs. And I'm not so sure this time. And I'll give you more supporting data. Again, could this somehow last 30, 60, 90 days extended? Yeah, but it's getting tougher and tougher as I see it. So let's just look at some of the FOMO in the market. This reminds me of the 2008. It reminds me of the 2000 period with the level of FOMO. Some of it's around crypto. It reminds me of 2020. Okay. QMM, for example. Look at this. A few days ago. Boom. Up 2,718. What was that all about, right? That was the peak in that day, came back here, and I think I'm short a couple days on the chart, but I assume it's probably staying in this. It may be up some. Okay. So QMM stock rocketed 2,736% after announcing a 100 million crypto treasury plan focusing on Bitcoin, Ethereum, and Solana, despite questions about the funding sources. Okay. How about another one? How about orbs, the symbol orbs? I think it's 8Co. Not to be outdone by 2,700, this one was up 5,602%. Guys, that's 56 times. And then it's starting to settle back. Again, not right up. There's probably another day in here. All right. So I remember in 2021, most of you can remember that. Those who traded crypto saw similar wild, wild numbers. Altcoins were doing these types of moves. Now, we've had some big runs in gold and silver stock, But look how delayed that was. You had the metal move up for 2 years, 250%, and saying, hey, the miners are going to start making more money. So that's a very undervalued situation. Yeah, it's a little stretch right now. I'll give you some data on that in a few minutes on what I think is going to happen. But we've already got GME, GameStop's back in play again. I don't know if Roaring Kitty's involved or he's off doing something else. So some more concerns come from overbought conditions. Let's look at a few charts. Okay. These come from currentmarketevaluation.com. S&P 500 price to sales ratio with standard deviation. So here we are. What's the period of time here? Okay. We go back to 2000. But we didn't have 2000 data. It looks like it just started after. And 2000 was the big dot-com high, right, guys? But look at this. Look at the historical average. We are over, right here, we are over 2.3 standard deviations above the historic average. We haven't seen anything like this in 25 years. And we are at an all-time high now. Little concerning, but no single factor makes me say, well, it can't go higher. But when you start adding everything up, how about PE ratios? These, in my opinion, matter. That's why I think the miners have so much higher to run in the commodity super cycle. First off, they have very low PEs. Even with this move up in the GDX, a lot. Now, they can have a 8 to 10% pullback. That's kind of what I'm expecting near term. But when they get the FOMO, when the buy the dippers on all the NASDAQ and all the FOMO stuff start realizing that that's not performing, just 0.3%, a half of 1% of the money of any single Mag 7 company. So why don't we take all 7 Mag companies and say if 1/10 of 1%, so together it's 0.7% of them. But you only, the gold and silver miners all together, the complete market cap of every single company is less than any single one company in the Mag 7. So if you get a tiny sliver coming in here, these things are going to FOMO so much higher than they are. But guess what? So that they're not as stretched on things like this, they're going to get re-rated. They're going to have 12 and 15 and 18 PE ratios as normal instead of sub 10 that they currently have for the most part. So look at this. You're 2 standards above the historical average, right? And look, now we see the internet bubble. So it got to 3 standard deviations. Okay, so that might argue if we want to be at that level, but you know what happened at that level? Do you know what happened to the NASDAQ? Went down 85%. So if we were at that level and we go to that level, that might be what we can expect. I'd much rather see this be limited to 20 or 30% pullback. Okay, last but not least, peoples, the Buffett. A few of you have heard of Warren Buffett. The Buffett indicator chart. Okay, standard deviations from the historical trend line. So what do we have? Let's read the data. The Buffett indicator is the ratio of the total value of the U.S. stock market versus the most current measure of total GDP. When this value is very high, like on these charts, it suggests the stock market is overpriced relative to actual economic productivity. Okay. So you see this line has been major resistance. We come up to it in the 70s, came down and bottomed out for a number of years, came back up in 2000 in the dot-com, and did an ABC retrace. And look at this. Again, very similar bottoming numbers into 2009. While we all know what the metals were doing in this period of time, right? The metals peaked here 2010, 2011, and really started their run at around 2001. So they're the same thing, you just turn it upside down and you have your super commodity cycle. Now here we are, and look at this. We've broken out of this, wasn't bad enough. We dipped, and then we turn around and came up, and now there's been no high like this. So again, very dangerous on the Warren Buffett scale. So here's a copper chart. Now, anybody that's familiar with technical analysis and chart patterns, what's the first thing you do when you see this kind of a chart? Forget what it is for a minute. So I got a pole and I got a flag. Now, if it's the other way, if my pole's here and my flag is flying out to the side, then I'm going to break up. But this is a bear flag, right? I need to flip it up and make it a bull flag. So it's very likely, not doesn't have to, guys, just more likely that this breaks down. What is it? It's copper. Well, copper is fundamentally an economic resource, right? Electrification, a lot of things, building. But if we're going to go into recession, copper is smelting, is feeling it out. And silver could get some of this effect, but copper doesn't have a monetary value as a proxy the way silver does. Silver is cheap gold. So oil is also in the same situation. But guys, I believe in this commodity super cycle that this could go here. And then once we get through this recessionary and it gets inflationary altogether in the stagflation, and we run up, the copper then once again gets taken up from a supply deficit standpoint. Remember, what's the cure for lower prices? Lower prices. What's that mean? That means that people stop producing something when it gets too cheap for them to profitably produce it. In foods, yeah, you get subsidies, and you don't really have subsidies in the metals. You have the government trying to say there's critical minerals, and we're going to put money in and we're going to help you go get them. You could view that as a subsidy to some degree. All right. That's out of necessity. Okay. So oil, I'm very bullish on oil in multiple years. I talk about again of seeing 150 oil, but before 150 oil, we're at around 58. Look at this. It's been continuing to be. There was a support level. Actually, there was a chart before this, guys. Yeah, that's what was happening here. Oh, sorry, that's US dollar. Take it back. So here's oil at $58. If we break that, is this the bottom? It could be. But if this recession, continues with inflation and stagflation, then I think it doesn't happen until early 2026. We could go to 43 on oil. The only benefit that cheaper oil does, it helps the miners. Miners use a lot of energy. They use a lot of oil turned into diesel to do all that excavation, all that digging, all that heavy work of tons of earth, right, that they process in gold and silver and copper and palladium and so forth. So if you notice, though, on the other side, what is really moving in the energy sector very explosively right now is uranium, because the AI and even that energy source is needed. So is oil ultimately. So is coal for that matter, especially in India and China. Those third world countries are still utilizing oil, coal, and natural gas a lot. In Europe also has a lot of colder weather climate like we do in our Midwest and Northeast. Um, And so they need a lot as well. So I don't really see a bear market in energy. I see short-term bearish things, but part of the commodity cycle is all things like that ultimately go a lot higher and it becomes a supply deficit situation. Okay. So what's my sum? I need to get through this, right? The market's going to open. So I'm cutting this a little short. I had some more to do on silver, but let me get to the dollar and then let me talk about precious metals. So, could we go higher in the stock market? Yes, it's possible. I'm not here, I hate to come out and say, but I'm not one to say, well, we might go up 10%, we might go down 10%. And people say, yeah, Bruce, we go up or down. You're not telling me anything. Well, listen to what I'm telling you. I'm telling you, probabilities say we've topped or are topping and we should go lower. And I'm talking about market indexes, not all things. Okay. So, what about gold? Well, 850 gold happened in 1980. Then we had 1911 gold in 2011. 850 gold, inflation adjusted, is 35.90 today. Well, where are we trading? 36, 37 depends on which, whether you're using future cash. Okay. So we've hit all true all-time highs in gold. So that's a breakout on any way you look at it. Okay. So what do I think could happen short term? Short term, 1 week, 2 weeks, 3 weeks. Well, I think we could pull back. With the central bank still buying on all the pressure, I think it's very likely that 3,500 holds. So I would be buying more there, or I would be buying more miners there. Okay. But what's a worst case scenario? Probably 33.50. So it would be an even better buy. Well, let me take it down after I show you some more charts and then just give you my very best and worst bull and bear case. And I think my best bull case is even higher than what I'm going to give you. I'm just going to give you a conservative number. Okay. So gold could initially go down with stocks and minor stocks go down also. We started in the overnight. We've come back up some. Um, so I'm going to give you a heads up. I'm very likely today. One of the problems you have, I'm out of my script here. One of the problems you have when you own a lot of OTC stocks, I own about 40 gold and silver stocks. Some of them are large cap, New York Stock Exchange, American Stock Exchange, so they're easy to sell. But some of the ones are OTC symbol. Well, OTC symbols have bigger spreads. They cost you money to trade them in some of the brokerages as opposed to no commission on New York and American stock exchange stocks, NASDAQ stock exchange stocks. But the OTC or the pink sheets, whatever you want to refer to it as, do. So they're a pain to sell. And I don't plan on selling them only to try and buy them back and have bid and ask spreads and all that kind of stuff because I don't see the gold stocks going down that much. But they could be hit 5 to 10% in a very short period of time, a week to 10 days, 2 weeks. So I want to be prepared. Instead of selling my stocks, I just go out and buy a 2x bear ETF. One of them on GDX is called DUST, D-U-S-T. The one on JNUG, the juniors, is JDUST, J-D-E-S-T. Let me just make sure. I hate, I'm going all this from memory, right? And then I'd hate to say, oh, they changed that symbol. Yeah, JDUST is a Bear 2X junior gold miners. And I know, and so JNUG is the long, JNUG is the long, and it's based off of GDXJ. All right. So you go, and then JDST is the short. And the same thing on GDX. If you want to go long, you can go long, a 2x long, you can go nugget, NUGT. If you want to do a 2x bear, you go dust, DUST. So I may just buy some shares of JDF's. Um, hang on, symbol. Yeah. So I mentioned those down here. But us get into the US dollar because that's kind of the inverse. Typically, gold and the US dollar trade in opposite, polar opposite. Now, they can have periods of time where they trade the same. Same thing in the stock market. Generally, when gold is rising, the stock market's going down. When the stock market is going up, gold is going down. Well, for 2 months, they've been, or longer, they've been both running up. And so that's not normal. So when you have months, months don't become years. This isn't something that's going to continue. So what do I think is going to change between those? What's going to continue going up and what's going to start going down? Well, I think gold is going to continue up. It may have an initial pullback when the markets pull back, but it will then go up and the markets will go down. Okay. So my bull and bear here are a simple um, I think we see gold at 3,800 by the end of the year. Could it go to 3,500, 3,350? Yeah. But mostly I think it's volatile and have some of the same stock markets chop. And what do I mean by that? Chop. Well, they go down 3% and then the buy the dippers cause it to go back up 2, then it goes down another 3, and it comes up 2. So you start going down, you have lower highs and higher lows. But I don't expect it for long in the minors. Okay. So look at this US dollar chart, which is definitely correlates with gold and the miners. Although the miners were very slow to wake up, gold ran for quite a while. So over a 2 to 3 year period, we've had this big base. Every time it came down and bounced off this base, even if it had a little false breakdown, it went back up until it didn't. So here we are in our current situation. Well, if the markets and gold both go down a little bit, the dollar could very well bounce back in this zone, almost look like it's going to break out, only to turn around and go back down. But we shall see. Where do I see the dollar in 5 years, 8 years? And this is 96 range, 97 to 96 down here at the bottom, $70, guys. That's how much the commodity super cycle will go up based on the dollar value going down. So it was holding for 2 to 3 years, but it's now broken that support range. So if we go back to 2008, this is interesting, guys. So what was 2008? I'm going to pull the chart up. It was the last financial crisis we had, right? You all remember that. It was mortgage-backed securities, how real estate mortgages were packaged, right? Liar loans, all the things that caused a major. We had Lehman Brothers collapse. It was, I remember it like yesterday. As I said, I was calling Fidelity with my 401k, and I'd moved everything into the money market. And there were some other money markets that par value of $1 wasn't $1. I called and I was on hold for 2 hours and I got somebody and I said, listen, I've got hundreds of thousands of dollars in the money market in my 401k. I need to know that that dollar value is a dollar value. That if I go to move it back to stocks or we get an all clear, you say, oh, we've repriced it at 85 cents on the. No, 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 you're okay, right? Well, I want to talk to your boss, right? And I was just panicking about that because some other companies had that situation in the money markets not going back to par value of a dollar. It didn't end up being a problem for me and I moved on through it, but I'll never forget that. All right. So, look at this trend when we go back to 2008, right? So the dollar bottomed and ever since then other than this false breakdown, the dollar has bounced off of this trend line that we're currently at. So there's where I started saying if we break that, now we can bounce back up to this level and eventually come down and break this. That at that point it projects down to about $70. It returns right back down here. Okay. So I talked about this. Stock market and gold been trading up to, it never lasts. It's typically for months, not years. So here's my bull and bear case. We could, in an awful situation, retrace to 3,000. And then that would absolutely have to hold. Having a two tag, 2,900, 2,999. Would I change anything? Would I get out of the goal I had or not buy miners? No. But I wouldn't like it. Okay. So I'm expecting as an absolute bottom 3,000. Anything lower is crazy and starts to change the dynamics. Okay. So on the upside, I think it's 10,000 or higher. So those are my cases, bear and bull. So Ray, I'm almost done wrapping this up, guys. Ray Dalio also supports the same goal thesis, right? I got an extra E in there. But the idea is he's come out lately. And remember, most people historically, if you have a financial advisor, they tell you, oh, you want to put 1% in gold, fine, put 1% in gold. They would not recommend, they're like 60-40 stocks and bonds. Right now, I don't want to own any bonds for me personally because I think they go down a lot. So, and I don't trust governments, to be honest. So he's saying 10 to 15% of your portfolio in gold. Well, I've got more than that. And then when I add in other miners, metals, other super commodity, commodity super cycle entities, that's 85% of my portfolio. So I'm all into this commodity super cycle. So expect energy, including oil, to bottom and then rise a lot. Agriculture is bottoming. I expect it to rise a lot. Rare earth and base metals, same kind of thing. Anything that's a physical, real product that people want, it costs money. And with the value of paper money going down, these things surge. So a retrace is likely. I thought I'd give you a final chart here. So here's GDX, okay? And we've hit even 70 and we bounce down and we're around here. So my plan is when this market opens that I will buy. I may watch to see what the Fed thing is, but I think it's stretched enough here. Now, I think that if it comes back here to this level, this 61 something in GDX, then I think we turn around and run way back up, guys. So I mean, you can ignore this, and I am in my a lot of my stock positions, but to have that insurance, I guess I could buy puts on GDX, but I find it easier to just go out and buy a J Dust, okay, or a J Dust or Dust. I've got the symbols there and especially in the fact that it's 2x, and then just look for a 10% move up, right? Because they're going to go up when the miners go down, and then take my profits and be out of that. That's a swing trade. It could be 3 days, it could be 2 weeks, but I don't expect it to be more than 3 weeks. But again, I'll watch the movement to tell me. I think any and all of you can do that if you've already got a huge portfolio of your miners. If you don't have all your miners in place that you want, then just wait to try and get more here. Okay. I already have a full portfolio of miners. So that's why I'm considering J Dust and or Dust. Okay. All right. I had more to include on silver and other things in the commodity super cycle, but guys, the market's going to open in 20 minutes. I need to upload this. I need to get a thumbnail. I need to get ready for the market. Okay. So hope you enjoyed this. This is something that I feel like you guys need. You know, I get it and I know this, but just showing you somebody else's chart and telling you, I think the market's going to go down and maybe it won't. Maybe we got 2 more months. And I get the trolls on there. Oh, yeah, Bruce, a lot of help. You said it might go up, it might go down. Well, duh, anybody knows that. No, I wanted to give you a lot of facts and figures to support what I'm telling you guys. Okay. Hey, this is Bruce with Targeted Wealth Creation. I'm not a financial advisor. This is not financial advice. I'll put this as a link to my Patreon as well, but it's going on the YouTube channel. I'm not giving away any of my valuable data in terms of what to buy, what percentages to buy, and all the things that I do for you guys on Patreon. And I appreciate y'all. I love my audience. You're growing like crazy. It's really, really good. All right, guys, have a good one. Bye for now.